Now let's talk about short sales. A short sale is a sale of real estate for an amount that will fall short of covering the full amounts owed on the loans, which are secured by the property, and the other fees and costs associated with the sale. In a short sale, the mortgage holder agrees to discount the loan balance due to either a financial or otherwise qualifying non-economic hardship on the part of the borrower, things such as job loss, relocation, divorce, or medical condition, just to name a few. A short sale is processed and negotiated through your lender's loss mitigation or workout department. Even though the proceeds of the sale are less than the outstanding balance of the loans, usually, but not always, the lender will accept the proceeds as full satisfaction of their debts. In such instances, the lender would have the right to approve or disapprove of a proposed sale. The circumstances surrounding whether or not a lender agrees to a short sale are usually related to the strength of the real estate market where the property is located, the borrower's financial condition, and the lender's ability to pursue the homeowner for the deficiency. So why do lenders allow short sales to be done? A short sale is typically executed to prevent a home foreclosure, but the decision to proceed with a short sale is usually based on the fact that it is the most economical way for your lender to recover the most amount of money possible at the least cost to them. Usually the lender will allow a short sale to move forward if they believe it will result in a smaller financial loss than would a foreclosure, as there are legal, carrying, and transactional costs that are associated with foreclosures and the subsequent resale of the property by the lender. You may be wondering, do I have to be in default to qualify for a short sale? This is a very common question I get from all of my clients, and unfortunately, there's no one easy way to answer it. Whether or not you have to be in default to get a short sale approved depends on a number of factors, the most important of which is who owns the loan. For example, if you have a loan owned by Freddie Mac, their guidelines say that you have to be 60 days in default to be approved for a short sale. If you have an FHA loan, you have to be 30 days in default by the time the sale closes. Fannie Mae's guidelines, on the other hand, say that the borrower must be able to prove they are in substantial danger of default. Other investors have their own guidelines, so if you're trying to do a short sale, but you also want to remain current on your mortgage payments, you might try calling your lender and asking them if that's even an option for you based on who owns your particular loan. Keep in mind, however, that it is unlikely that your lender would actually tell you that you should default, so if you don't get a straight answer from them, you might want to consider consulting with an attorney familiar with the short sale process to help you figure out if staying current is even an option for you. I can tell you from experience, however, that lenders tend to take borrowers who have already proven they are willing to sacrifice their credit in order to get a short sale done more seriously than those who wish to remain current. While this may not make much sense at first glance, the reason is because being in default puts the lender on notice that if they don't approve a short sale, they're likely to end up having to take the property back through foreclosure, and taking another home back on their books is the last thing they want to do these days. Defaulting on your mortgage is a personal decision that should not be taken lightly. I strongly urge you to seek the advice of a professional if you are not comfortable making this decision on your own. So, what are the advantages of pursuing a short sale? Well, there are several. The seller will avoid a foreclosure appearing on their credit history, and they can have partial control of the repayment terms if the lender does not grant a full satisfaction of the debt as part of the short sale. A short sale is typically also faster and less expensive than foreclosure for the lender. However, it does not extinguishing the remaining balance of the loans incurred on the property unless that settlement is clearly indicated by the lender on their short sale approval letter. This is true even for first mortgages, as the lender is simply agreeing to release the lien on the property in exchange for a lump sum payment of less than the full amount owed, rather than exercising their foreclosure rights. So, let's talk about deficiencies. Usually a full release of liability for a mortgage loan deficiency can be obtained from a first mortgage lien holder in a short sale. However, junior liens, such as second mortgages, often do not agree to a personal release of liability for the amounts remaining unpaid, even if they agree to let the sale go forward. This is especially true if the borrowers have substantial income or assets. A non-foreclosing lender has the right to bring an action to collect upon any remaining deficiencies from the date the account is settled per the terms of the short sale. How long they have to pursue a borrower depends on the laws of the state the property is located in. When the time comes to negotiate a short sale, make certain that whoever is negotiating with the lender on your behalf attempts to get a personal release of liability for all mortgages and liens against the property. Keep in mind, however, your creditors are certainly under no legal obligation to grant this to you. In the end, the chances of obtaining a personal release of liability will depend on how much you're able to sell the home for, and if you're willing or able to contribute any of your own funds towards paying off the remaining balances. There are essentially two types of short sales. The first is a traditional short sale, and the second is called a half a short sale. Let's look at a traditional short sale and how it works.